The US dollar has had another good week. It has lost some momentum and the 10-year Treasury note yield has steadied around 3% after its steep rise in April. But US dollar price action around the FOMC statement this week reinforces our view that the dollar recovery has some way to run. At this week's policy meeting, the Federal Reserve kept its key interest rate steady at 1.5 to 1.75%. This was very much expected by markets, so attention focused on the wording of the FOMC statement. This could easily have been taken as leaning dovish. In particular, the FOMC inserted the word symmetric when talking about its 2% inflation objective. Early in the week, we saw data on the Fed's preferred inflation measure. This rose from 1.7% year on year in February to 2% in March. There has been a clear pickup in US inflation momentum this year, even leaving aside the rise in global oil prices to highs since 2014. But the Fed's reminder that the 2% inflation objective is a target, not a ceiling, can be seen as a heavy hint to markets not to get excited about aggressive rate hikes if inflation is above 2%. Consistent with this reading, US yields fell a little and the US dollar also fell. But the greenback soon recovered. The euro and the pound, for instance, slumped to lows since mid-January. We will hear plenty from Fed officials in the week ahead and expect their tone to be mostly upbeat, reinforcing near 100% market pricing for a June rate rise, followed by at least 2 more by mid-2019. If this positive mood on the US economy continues, then we should be in for another week of US dollar gains against most currencies. But the Aussie dollar could perform a bit better than most. The past week has produced Aussie dollar lows dating to June 2017 against both the US dollar and against a basket of major currencies. But the lack of fireworks on the Aussie's break of 75 cents hints that investors aren't particularly bearish. Moreover, Australia's domestic news and data could help the Aussie dollar's mood. After this week's policy meeting, the RBA said it is sticking to its view that Australia's economic growth will average a bit above 3% in 2018 and 2019. Tuesday's federal budget could reinforce such forecasts with heavy hints of cuts in corporate and personal tax rates, which would help growth. Furthermore, iron ore prices have picked up and we saw a bounce in building approvals plus a $1.5 billion trade surplus in March. So while in the week ahead we can't rule out the Aussie printing fresh one-year lows in the mid-74 cent area, it seems to be on more stable ground near term and could spend most of its time hovering either side of 75 cents. We'll speak to you next week.